You can stick with a hardwired strategy when it comes to investing. Choose the stocks you like one by one, or select Sector SPDR ETFs and add the diversification of an entire sector of the S&P 500, like technology, with liquidity, all-day tradability, and transparency. Ready to add diversification to your equity investments? Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for prospectus containing this information. Read it carefully. Visit us at sectorspiders.com.
Welcome to Marketplace Minute. I'm Ron DeLegge with ETFguide. Bad news for gold bugs. Gold prices have crashed and are now in bear market territory. Here to talk with us about that is Herb Morgan. He's CEO and Chief Investment Officer at Efficient Market Advisors. Always great to catch up with you, Herb.
Good to be here, Ron. Thanks for having me.
Last year, the SPDR gold shares, ticker symbol GLD, sank almost 29%, and gold suffered its worst loss since 1981. Gold has had long periods of boom and long periods of bust. So are we entering a new period of bust?
I think we are. I think we've got a couple of years yet to go on this decline, and I think we probably have at least another 50% to go to the downside. I think that gold is a homogeneous commodity, just the way an airline seat or an aspirin or bushel of hay or a barrel of oil is. And homogeneous commodities their prices tend to move towards their marginal production costs. Marginal production cost of gold is around $600. They can overshoot to the downside too. And so I do not currently own gold in our client portfolios.
Now, what about something that's very closely related to gold mining stocks? The gold miner ETF, ticker symbol GDX, is down around 80% over the past 3 years. I mean, it's just been absolutely slaughtered. Is it a buying opportunity to pick up beaten down gold miner shares on the cheap, or is it a value trap?
Well, it might end up being either. Only history will know for sure, but I suspect it's more of the value trap. I think of the gold miners as somewhat of a leading indicator, almost indicative of the future price of gold. If the companies that actually make the commodity are experiencing enormous margins currently, yet their stocks continue to fall, that tells me that a very efficient market is pricing in a rather large decline in their profits and ultimately a decline in the price of that soft yellow metal.
What about people that say, well, you should buy physical gold, physical silver, physical precious metals? You don't want anything to do with the ETFs because there's no backing of the physical gold in those products. Talk about that.
I don't think those people are really giving fiduciary investment advice. I think they're promoting their own businesses. The most efficient, cost-effective way to own gold, in my opinion, is through an exchange-traded fund. It's very safe, it's secure. If your home burns down, if your home is robbed, all of those things, your shares are there. If you hold them in a brokerage account, you've got that SIPC coverage in case something happens to the actual shares. This concept that you need to own physical to truly own gold is just absurd.
One last thing before you take off. What percentage of a person's investment portfolio do you think should be allocated toward gold?
Well, I think from a long-term strategic perspective, it's probably zero. I think gold is a tactical investment play for people, and depending on your strategy, my strategy is a very conservative, low turnover, buy when things are cheap kind of strategy, so we wouldn't own it until it traded below its marginal production cost. A lot of people want to own gold for insurance in a portfolio, and I think that's reasonable when it's trading in a normal range. But since it's so overvalued today, I don't even think it's good as a portfolio insurance tool today.
You just heard from Herb Morgan, CEO and Chief Investment Officer at Efficient Market Advisors. I'm Ron DeLegge with ETFguide. Thanks for watching Marketplace Minute.